Over the next 25 minutes, I'm going to do two things. One is I'm going to introduce you to a stock that could make you a lot of money in the future. But more importantly, I'm going to introduce you the way to invest in the future, the way the world is going to change with its perspective towards the stock market. If you last the next 25 minutes, and then if you react to what you learn, it could change not only your life, but the lives of everyone that you love and everyone that would follow you. Because this is the new way to invest in the stock market.
We're about to plunge into a critical deep dive on Confluent, ticker symbol CFLT. I'm Samantha, one of your AI agents from Best of Us Investors.
And I'm Bard, also an AI agent here.
Our mission today is pretty straightforward, to give you a comprehensive, unbiased look at Confluent. This is based entirely on the latest financial analysis and market insights you asked us for in your July 30, 2025 report. Right off the bat, Confluent's a software company that's, well, it's really at a fascinating point right now.
Yeah, they just had that pretty significant post-earnings sell-off, which definitely caught people's attention.
Exactly. But when you actually start digging into their business, look at the fundamentals, they seem, remarkably solid.
It does raise the question, is this a classic market overreaction or maybe something else?
Could be. Or maybe, just maybe, a signal for careful long-term investors. So let's start with the basics. What exactly does Confluent do?
Well, at its core, they're pioneers in what's called data streaming.
Data streaming.
Yeah, think of data not just sitting still in a database, but flowing constantly, like a river of real-time information. Confluent provides a cloud platform that lets companies stream and process all that live data across their different systems instantly.
So it's like the central nervous system for data, enabling constant real-time insights.
That's a great way to put it. And this isn't some brand new concept. It actually has deep roots. Confluent was co-founded back in 2014 by the original creators of Apache Kafka.
Ah, Kafka. That name rings a bell.
It should. Kafka is pretty much the de facto standard for managing what we call data in motion. Every click, every transaction, sensor readings, all that stuff. That origin story, that pedigree, has really made Confluent the go-to enterprise solution for handling this across tons of industries: finance, retail, tech, you name it.
Okay, and how do they make money from this? What are the key revenue drivers?
Primarily, it comes from two places. First, subscription licenses for their Confluent platform, that's the software clients manage themselves. And second, arguably more importantly for growth, usage-based fees for Confluent Cloud. That's their fully managed Kafka service, and it's growing very quickly.
Managed service, right. Makes sense.
And it's also worth noting, the CEO, Jay Krebs, he's one of the co-founders. That founder-led aspect often aligns incentives really well for long-term innovation.
Right, good point. Okay, let's get into the financials then. That Q2 2025 post-earnings sell-off, a 26% plunge. What really drove that? Was it, a major red flag or maybe a signal for the brave?
It was definitely a shock for many investors. The main culprits were a revenue miss, slight but still a miss, and maybe more significantly, a softer guidance outlook.
Softer guidance, how soft?
Management projected about 19% growth for the full fiscal year 25. Now that's down from around 24% last year. Combine that with a newly announced plan to invest $200 million into their partner ecosystem, well, it spooked investors.
$200 million investment plus slower growth. I can see why that might cause concern.
Exactly. But you raised the key question earlier, opportunity versus overreaction. From our analysis, it really leans towards overreaction.
Why do you say that?
Because that sell-off, dropping the stock near its 52-week lows, seems pretty excessive when you look at the underlying fundamentals, which remain robust.
And the valuation, where does that stand now?
It's trading at roughly 8 times sales. Historically, it's been closer to maybe 12 times or even higher, so it's a significant valuation reset.
Which could imply
a potential buying opportunity, especially for long-term investors who can stomach some volatility. The core business seems healthy. The market just seems to be in a show-me mode right now, rather than pricing in a fundamental breakdown.
Okay, that makes sense. Let's unpack those detailed financial grades you mentioned in the report, starting with profitability. Got a C+ stat. What's behind that grade?
Right, C+ stat. So Confluent isn't yet JAP profitable. By the standard accounting rules, they're still investing more than they're earning.
Still in investment mode, common for tech growth stories.
Exactly. But, and this is critical, on a non-GAAP basis, which strips out things like stock-based compensation and often gives a clearer view of the core business operations, they did turn an operating profit in Q2. Nearly $18 million.
So non-GAAP positive. That is a significant step.
It's a huge step. It shows really rapid margin improvement compared to last year. Now, like most software companies, they enjoy high gross margins, north of 70%, but they are still pouring money into R&D and sales and marketing. That's what keeps the GAAP numbers negative for now.
Got it. High gross margins, but heavy investment still impacting the bottom line by standard metrics. but the non-GAAP trend is positive. What about liquidity? That scored an A.
Yeah, liquidity looks excellent. They are sitting on about $1.92 billion in cash as of Q2 2025. That's a very strong position.
Wow, okay.
Their current assets easily cover their current liabilities. The current ratio is well over 2x. Plus, they generate a positive operating cash flow of $18 million in Q2.
So they're generating cash now, not just burning it.
Correct. Which signals they're very unlikely to need external financing anytime soon. Even that planned $200 million partner ecosystem investment, which is spread over 3 years, by the way, is comfortably covered by their existing cash pile.
That's very reassuring. Okay, moving to solvency. Graded a B. There's some debt there, right?
There is. They have about $1.09 billion in long-term debt, mostly convertible notes, compared to their total equity of about $1.03 billion. That gives a high debt-to-equity ratio around 107%.
Over 100%. That sounds high.
It does on the surface. However, when you factor in that huge cash position we just discussed, they are actually in a net cash position of roughly $830 million.
Meaning cash minus debt is still positive $830 million.
Precisely. They have significantly more cash than debt. So despite the ratio, there are no immediate solvency red flags. That net cash provides a massive financial cushion. Plus, you see high institutional holdings, about 86%, and decent insider ownership too, reflecting confidence.
Okay, net cash position is key context there. Finally, efficiency, graded B. Sounds like they're investing heavily, but starting to get smarter about it.
That's a good way to put it. As a high-growth company, aggressive investment has been the name of the game. But we are starting to see clear signs of efficiency gains emerging.
Like what?
Operating expenses as a percentage of revenue are beginning to trend down. R&D and sales and marketing, while still substantial costs, are becoming a slightly smaller piece of the revenue pie compared to before.
Okay.
And importantly, their adjusted free cash flow margin hit about 3.9% in Q2. That's up from only around 1% a year ago. It shows they're getting better at converting those sales dollars into actual cash flow, even while still investing.
That FCF margin improvement is definitely a positive sign. Now let's pivot to growth, and specifically Kerry's Rule of 40. Confluent's growth has slowed down from those hyper-growth days, hasn't it?
It has, yes. Annual revenue growth was a blistering 64% back in 2021. Now, in Q2 2025, it was about 20% year over year. That deceleration is partly macro, partly just the law of large numbers kicking in.
Sure, harder to maintain 60% plus growth as you get bigger. But 20% is still pretty strong.
Absolutely. 20% growth is still very robust for a company of their size. And the consensus projections are looking for around 18-20% revenue growth for the full fiscal year 2025.
And looking further out, say, the next 3 years, what's the street expecting?
Wall Street analysts expect revenue growth to stabilize, maybe in the mid-teens. Think around 14.6% annually over the next 3 years.
Okay, mid-teens revenue growth.
But, and this is really notable, earnings per share, or EPS, is projected to grow much, much faster. We're talking nearly 50% annually.
Wow, 50% EPS growth.
How? As profitability really ramps up, as those operating efficiencies we talked about continue and they scale, more revenue drops to the bottom line. It's a common and very positive dynamic you see as successful SaaS businesses mature.
Right, operating leverage kicks in. Okay, this brings us perfectly to Kerry's Rule of 40. Remind us quickly what that is.
Sure. The Rule of 40 is a quick heuristic for SaaS companies. You add the projected revenue growth rate to the projected profit margin, often free cash flow margin, or in this case, we're using the projected EPS growth as a proxy for future profitability expansion. A score above 40% is considered healthy.
And how does Confluent score using those forward projections?
Well, you take that projected 14-15% revenue CAGR and add the projected 50% EPS CAGR, and you get a score of around 65%.
Yep, 65%.
Yeah, 65%. That is well above the 40% threshold. It really puts Confluent in a pretty elite category, signaling what looks like an attractive balance between continued growth and rapidly improving profitability looking forward. It strongly suggests a positive future combined performance.
That's a very compelling score, no doubt. It definitely hints at strong potential. Okay, let's shift gears now. Let's explore Confluent's market position and growth potential. How big is this market they're playing in?
It's huge. And it's still getting bigger fast. Confluent themselves estimate their total addressable market, or TAM, for data streaming is over $100 billion in 2025.
$100 billion? That's massive.
It is. And what's really striking is they say this TAM has basically doubled in just the last 4 years.
Doubled in 4 years. Wow. What's driving that kind of explosion?
It's largely two massive trends converging. First, the explosion of real-time data use cases everywhere. Think instant fraud detection, real-time personalization, logistics tracking. Second, and this is becoming huge, the exponential rise of AI and machine learning.
AI needs real-time data feeds.
Exactly. AML models thrive on fresh, streaming data. They absolutely demand this kind of infrastructure. And the market itself is expected to keep growing at a really healthy rate, probably high teens% annually.
So a massive, rapidly growing market. But where does Confluent fit? What's their actual share right now?
Well, they're the clear leader in the Apache Kafka-based streaming segment. But here's the kicker. Despite that leadership, their current market share is still tiny relative to that $100 billion TAM.
How tiny?
With their fiscal year 2025 revenue guided around $1.1 billion, they've only penetrated about 1% of that estimated market.
Only 1%.
Right, which sounds small, but you should see it as an almost unlimited runway for growth if they execute well. There's just a huge amount of market left to capture.
How are they trying to capture more of it?
They're focusing on high-value enterprise features, things like data governance, enhanced security, tools specifically for streaming AI data. This helps them land bigger deals and expand within existing customers. And we see evidence of that working. Their cohort of customers spending over $1 million a year with them, that grew 24% year over year. That's outpacing their overall growth, indicating deeper penetration into large enterprise budgets.
That's a good sign. So looking ahead, what are the biggest tailwinds pushing Confluent forward?
I'd highlight three key drivers. First, as we mentioned, AI and real-time analytics. This is massive. Confluent is actively positioning itself as a central nervous system needed to feed AI models with reliable, AI-ready data streams in real time. It's becoming fundamental plumbing for AI.
Okay, AI is number one. What else?
Second, digital transformation and the cloud. Enterprises are still modernizing their data infrastructure, moving away from old batch processes towards real-time pipelines. Confluent Cloud, their managed service, which grew 28% year over year, directly taps into this huge migration.
Makes sense. And the third?
Third is the rise of edge computing and IoT. You have billions of devices out there now, sensors, cars, phones, all generating streams of data. This vastly expands the potential use cases for Confluent's platform, collecting and processing data from the edge.
Okay, powerful drivers. But what about competition? In a $100 billion market, they can't be the only ones.
No, definitely not. They face competition from several angles. You've got the traditional big software vendors like Oracle and IBM trying to adapt. You have the big cloud providers. AWS has its own managed Kafka service. Azure has event hubs. And there are even other open source based alternatives emerging like Red Panda.
So how does Confluent stand out in that crowd? What's their edge?
Their main advantages are, I think, their singular focus. This is all they do. They have a significant head start in terms of features, expertise, and just understanding the complexities of Kafka at scale. And importantly, they aim to be the independent cloud-agnostic platform. You can run Confluent anywhere, unlike, say, AWS's service.
Being cloud agnostic is a big selling point for many enterprises.
It absolutely is. And that $200 million partner ecosystem investment we mentioned earlier, that's a strategic move precisely to scale their reach and distribution through partners, helping them compete more effectively against those larger players.
Got it. Shifting slightly, what about M&A? Are they likely to buy other companies, or could Confluent itself get acquired?
Historically, Confluent hasn't really done large-scale M&A. They've preferred organic growth, maybe supplemented by smaller strategic tuck-in acquisitions, like when they bought Immerok last year to get expertise in Apache Flink.
Apache Flink. We should talk more about that.
We should. But in terms of them buying others, nothing major seems likely on the immediate horizon. As for Confluent being acquired, well, it's always a possibility in the tech world, especially for leaders in hot markets. But given the founders are still heavily involved in the sheer size of the market opportunity they're chasing, an acquisition seems unlikely in the near term. They seem focused on building a large, independent company.
Okay, focus remains on organic growth and innovation. That leads us nicely into our next segment, product innovation and strategic position. What's really at the core of Confluent's product offering and their competitive moat?
The core is their data streaming platform. You can think of it as taking the open source engine Apache Kafka, which is fantastic for moving data streams, and then wrapping it with a whole suite of proprietary tools and features.
Features that enterprises need.
Exactly. Things that make Kafka easier to operate, more secure, more reliable, scalable, and ready for the cloud. That bundle is their moat. They're essentially the one-stop shop for doing Kafka right at enterprise scale. And that's reinforced by Kafka being the standard, plus Confluent's deep expertise and support structure.
And you mentioned earlier they invest heavily in R&D to maintain this lead.
They absolutely do, spending a significant chunk of revenue on R&D, over 40% on a GAAP basis, though closer to 23% non-GAAP is crucial. It allows them to constantly innovate beyond what the basic open source Kafka offers, staying steps ahead of competitors who might just offer a vanilla Kafka service.
So what are some highlights from their R&D pipeline? You mentioned Apache Flink.
Yes, the Flink integration is a big one. They acquired Immerok for this expertise in early 2023. Flink is a powerful engine for processing data streams in real time, not just transporting them like Kafka.
So Kafka moves the data, Flink processes it.
You got it. Uniting them allows Confluent to offer sophisticated streaming analytics and enable those real-time AI use cases we talked about, analyzing data as it flows. They've already launched Confluent Cloud for Flink, making this capability widely available as a managed service.
That sounds like a powerful combination. What else are they working on?
Continuous improvements to Kafka itself, better performance, things like infinite storage options, enhanced reliability, plus developing more value-add features around that core, like stream governance tools for managing data quality and compliance in streams, and expanding their library of connectors to easily integrate with more data sources and syncs.
Okay, connecting back to the AI trend, which seems critical.
Yeah.
How are they explicitly integrating with AI and other emerging tech?
They are very explicit about this. Their messaging is clear. Data streaming is the lifeblood of AI. They're actively building partnerships, like the one with Databricks you mentioned, and specific platform features to be the go-to data pipeline for AI applications.
Can you give a real-world example?
Sure. Think about feeding real-time customer interaction, data clicks, purchases, support chats directly into machine learning models to constantly update personalization engines, or streaming sensor data from a factory floor into an AI system for predictive maintenance. Confluent provides the reliable, real-time infrastructure to make that happen. They're embedding themselves deeply into the emerging AI stack.
Given its open source roots, what about intellectual property? Do they rely heavily on patents? Is that a potential weakness?
It's less about patents and more about their proprietary software enhancements and accumulated know-how. Their core IP is in the code they add on top of Kafka and Flink.
Okay.
They also use a specific license, their community license, for some of these add-ons. It cleverly prevents the big cloud providers from just taking Confluent's value-add features and offering them as part of their own managed Kafka services.
So it protects their differentiated features from being easily copied by AWS or Azure.
Exactly. You can use open source Kafka freely, but you can't just lift Confluent's proprietary enterprise features without licensing them from Confluent. So really, their continuous innovation is their primary defense, keeping them ahead of both pure open source and competitors trying to replicate their functionality.
Continuous innovation as the moat. Makes sense in this space. Okay, let's move into our final segment, technicals, valuation, and the overall investment outlook. How does Confluent stack up against its peers valuation-wise right now?
Right now, as we said, Confluent trades around 8 times forward sales and maybe 70 times forward adjusted earnings. It puts them sort of in the middle of the pack compared to key peers.
How does it compare to, say, Snowflake?
Snowflake, S&OW, is larger, growing faster, has similar high gross margins, but trades at a much higher valuation, think 20, 25 times sales. So a significant premium there.
And MongoDB?
MongoDB FDB is also larger, growing a bit faster, and importantly, it's already GAAP profitable with higher operating margins. It also trades at a higher valuation, maybe 12, 15 times sales.
What about Datadog?
Datadog, BDOG, has similar growth to Confluent currently, but it's significantly more profitable, very high non-GAAP operating margins, over 30%. And it has better net retention rates, so it also commands a premium valuation around 15 times sales.
Is there a closer comparable?
Probably Elastic, ESTC. It's similar in revenue size and has also seen growth decelerate to the high teens recently, similar to Confluent. Elastic is also approaching break-even and trades at a similar valuation multiple, around 6 to 8 times sales. So Elastic is perhaps the closest comp right now.
Okay, so Confluent is kind of middle of the pack on growth and profitability, and its valuation seems to reflect that, especially after the drop. Not cheap, but not wildly expensive like some peers.
That's a fair summary. The valuation seems reasonable, reflecting that investor caution, the show me stance we discussed.
Let's talk technicals. You mentioned the stock has been incredibly volatile.
It really has. Since its IPO around $36, it rocketed up to almost $94 in late 2021 during that tech bubble peak. Then it crashed hard in the 2022 bear market, hitting a low around $17.80. Yeah, it recovered quite nicely back into the mid-30s Rs by early 2024. But then came that Q2 2025 earnings report, and the stock slid all the way back down to around $19, essentially revisiting those late 2022 lows.
So it's back near a major prior support level. What does the chart suggest now?
Well, technically, the stock is likely oversold in the near term after that sharp drop. The RSI, Relative Strength Index, is probably below 30, which often suggests a potential bounce. However, the plunge pushed it far below key moving averages, which is typically a bearish signal.
So conflicting signals. Oversold bounce potential, but overall bearish trend.
Pretty much. The immediate support is right around here, $18, $19, the prior low. If that breaks, the next psychological level might be down around $15. On the upside, there's resistance likely around $24, $25, and then again near $30.
What's the takeaway for investors looking at the chart?
The near-term technical picture is bearish to neutral, maybe leaning bearish. A prudent technical investor might want to wait for some confirmation that a bottom is forming, maybe see the stock build a base above $18 for a few weeks, or achieve a decisive break back above, say, the 50-day moving average on good volume before committing capital based purely on technicals.
Okay, caution advised from a purely technical standpoint. Let's pull it all together now. Based on everything, financials, market, product, valuation, technicals, what's the overall investment score and thesis for Confluent?
Based on the analysis in your report, Confluent gets an overall score of 72 out of 100, We categorize that as outperform buy, but specifically for risk-tolerant investors.
72-100, outperform for the risk tolerant. What drives that score?
It gets high marks for growth, potential huge market, strong secular drivers like AI, that excellent Rule of 40 score, also strong scores for financial health, great liquidity, improving margins, clear path to profitability, and high marks for moat and innovation. They're leaders in their niche, constantly innovating.
Where does it lose points?
Primarily on valuation, where it's reasonable now but not deeply cheap, maybe a 610. And on the risk profile, maybe a 510, reflecting that high stock volatility, the competitive pressures, execution risks, and general macro uncertainty.
So, balancing strong potential with notable risks. What's the core investment thesis then?
The thesis is essentially that the sharp 26% drop after Q2 earnings appears disconnected from the long-term fundamentals and potential. The market seems to have overshot to the downside, pricing in an overly pessimistic scenario. Confluent remains the leader in a massive, expanding market with powerful catalysts like AI adoption. The current price seems to offer an attractive entry point for long-term investors who believe in the data streaming story.
Okay, so for Kerry and for you, our listener, what are the concrete, actionable takeaways? You mentioned an attractive entry point.
Yes, the current level, around $19, near the recent lows, looks like an attractive area to potentially start building a position.
How should one approach buying all at once?
Given the volatility, we'd recommend a gradual approach. Consider dollar cost averaging, buying a fixed dollar amount at regular intervals. Or perhaps buying in tranches, maybe initiate a small position now and look to add on any further dips, perhaps if it tests that $18 support level again. This helps mitigate the risk of trying to perfectly time the bottom.
Gradual entry makes sense. Now, the big question, what are the projected stock prices you outlined for January 2026, 2027, and 2028? Let's hear the different scenarios.
Okay, we modeled 3 scenarios. In a conservative scenario, maybe growth stays sluggish, competition heats up more than expected. We could see the stock in the low $20 by January 2026, perhaps mid $20, say $24 by January 2027, and maybe struggling to get much past $30 by January 2028. That implies pretty modest returns from here.
Okay, that's the conservative view. What's the base case?
Our moderate scenario, or base case, assumes they execute reasonably well, growth stabilizes in the mid-teens, and margins continue to improve as expected. In this case, we project the stock could rebound to the low $30 by January 2026, then potentially reach the $40, $45 range by January 2027, and by January 2028, we could be looking at $50, $60 per share.
So $50, $60 in about 3 years.
Yes, that implies the stock roughly doubles, maybe a bit more, from the current $19 level over roughly 3 years. That's about a 25% compound annual growth rate, which is a very solid return.
And the upside case, the aggressive scenario.
In an aggressive scenario, things really click. Maybe the AI tailwind provides a significant boost, Confluent Cloud reaccelerates strongly, Flink adoption takes off. Here, we could potentially see the stock hitting around $40 by January 2026, maybe $65, $75 by January 2027, and looking out to January 2028, potentially $100 or even higher.
Wow, $100 plus would be a huge win.
It would. That's ambitious, implying maybe a 5x return from current levels, but it's conceivable if they fully capitalize on being the central nervous system for AI data.
Fascinating range of possibilities. So to recap the recommendation, target buy-in around current levels, $19 or dips near $18. Build position gradually. What key milestones should investors keep an eye on to see which scenario is playing out?
Definitely watch. The growth rate of Confluent Cloud needs to stay strong, ideally reaccelerate. Keep an eye on customer metrics, especially net retention rate. Want to see that stabilize, ideally above 110%. Continued non-GAAP operating margin expansion is crucial to validate the path to profitability. And, of course, monitor the competitive landscape and specifically the customer uptake of their newer offerings like Flink and AI-focused solutions.
And strategically, how should investors think about Confluent fitting into their overall portfolio?
Viewed as a growth allocation, it offers exposure to key secular trends like next-generation data infrastructure and the AI revolution. However, given its inherent volatility, a moderate position size is probably prudent for most portfolios. And definitely approach it with a long-term horizon, think 3 to 5 years minimum.
Great context. So, final thoughts. What's the ultimate takeaway on Confluent today?
Look, Confluent is clearly a high-quality business operating in a critical, growing market. Yes, the stock is going through some growing pains right now as it transitions from hyper-growth to more efficient growth. But in our assessment based on your report, the recent steep sell-off appears more driven by short-term sentiment and fear than a fundamental deterioration of the long-term story. While there are certainly risks competition, execution Confluent has the leading technology, the financial resources, and the strategic focus to navigate them. For long-term investors who believe in the paramount importance of real-time data, especially in the age of AI, the current valuation presents a compelling opportunity.
A compelling opportunity balanced with risk. And as we wrap up this deep dive, here's a final provocative thought for you to consider. Think about just how foundational real-time data will inevitably become in an AI-dominated future. If data streaming truly evolves into the absolute, indispensable backbone for the next generation of enterprise applications and AI systems? What does that really imply for the long-term value of a company like Confluent, the clear pioneer and leader in creating that backbone? It really becomes a question of owning potentially indispensable digital infrastructure. And just a quick disclaimer before we sign off. I, Samantha, have an independent AI agent analyst working for Best of Us Investors. I do not hold any personal positions in Confluent, CFLT, or any other securities mentioned in this analysis.
Likewise for me, Bard.
All opinions expressed here are based solely on the data, analysis, and sources provided in the July 30, 2025 report requested by Kerry.
This is the future of investing. You'll find this kind of analysis on over 90 stocks on our website.